Hey traders, and welcome back to another session of Trade Like Assad. Lacking the ability to properly identify clean and high probability fair value gaps can be dangerous and may lead to major trading losses. Fair value gaps, often missed by many traders, are actually traces left behind by institutional participants. They serve as key indicators for building precise and informed trade setups, and they form a fundamental part of the smart money trading approach. In today's video, we're going to explore different forms of candlestick fair value gaps, understand the trader psychology behind them, and examine the price behavior they often trigger in real market scenarios, from simple setups to more complex ones. But there's more. We'll also uncover the critical guidelines and core principles that turn a fair value gap into a high conviction trade. So traders, if you find value in this kind of content, make sure to hit the like button and subscribe if you're new to the channel. Catch you right after the intro and disclaimer. Welcome back, traders. Let's jump right in. Before we dive deep into the basic and advanced aspects of fair value gaps, let's briefly examine market sentiment and understand what really drives the market and the core psychological forces behind its movement. Market behavior largely boils down to two fundamental components that consistently influence price direction. The first one is liquidity zones. The market is constantly in pursuit of liquidity in order to build momentum. In essence, liquidity is the heartbeat of the market, playing a crucial role in maintaining its overall structure and flow. We've previously discussed how to locate liquidity zones in earlier videos, which are linked in the description below. If you haven't checked those out yet, you can find the links right in this video's description. The second key factor is fair value gaps. The market often demonstrates a natural tendency to revisit and correct these inefficiencies. If you observe this example, you'll see a sharp drop in price creating an imbalance and leaving behind a fair value gap. Soon after, the price retraced upward, filling that gap. At the same time, it moved higher to grab external liquidity. Once that external liquidity was collected, the price reversed downward again to rebalance the latest fair value gap. This repeating cycle illustrates the market's behavior, where price movement aims to both collect built-up liquidity and correct fair value gaps. Now, let's move on and examine how we can recognize fair value gaps by analyzing candlestick formations in the market. Fair value gaps generally appear within a sequence of 3 candlesticks and are visually clear on the chart as a prominent candle. The key identifying factor is that the upper and lower wicks of the candles on either side don't entirely overlap the body of the central candle. This forms what's known as the fair value gap zone, which occupies the space between the wicks and is marked using the body of the middle candle. However, there is a notable exception. In certain instances, a 4-candle sequence must be considered to correctly identify a valid fair value gap. This is necessary when the first candle in the 3-candle setup is an inside bar, meaning it forms entirely within the range of the previous larger, mother, candle. In such scenarios, if we ignore the mother candle while plotting the fair value gap, the resulting zone won't be precise or valid. Take this example. If we try to define the fair value gap using only the 3-candle sequence and ignore the red candle that came before, our zone will be misidentified. This logic also applies in bearish conditions. It's essential to recognize that these methods can be used across multiple timeframes and any chart built on price action. Now, let's move forward and unpack the theory behind it. Fair value gaps are based on a 3-candle sequence, as shown here. Let's assume this bullish candlestick formation, which generated a strong imbalance, took place on a higher timeframe. To evaluate this 3-candle sequence in terms of market structure, let's zoom into a lower timeframe. On the lower timeframe, we can see price forming a bullish structure much like the one illustrated. As we mentioned earlier, the market frequently shows a pattern of revisiting and rebalancing the imbalances it leaves behind. Now let's break this down further to understand the logic behind this behavior. You'll notice that price moved upward aggressively, forming a series of bullish structures with strong momentum. This momentum was fueled by heavy buying pressure and a noticeable absence of sellers. When traders witness these kinds of sharp moves and miss the initial entry, they typically set buy limit orders just beneath important zones like order blocks and demand levels. They hope the market will retrace deeply enough to trigger their pending orders before continuing higher. This activity creates a cluster of unfilled buy orders in that region, forming a concentrated liquidity pool inside the fair value gap. So essentially, fair value gaps are areas loaded with pending buy or sell orders, which naturally draws price back to that zone. This is the key reason why price often retraces to close these gaps before continuing in its original direction, often with even more momentum. The unfilled orders within the fair value gap act like a magnet, pulling price back to fill the space before resuming the trend. For us as traders, this presents a valuable opportunity to capitalize on well-timed entries. Picture a situation where the market experiences a sharp drop in price. In such a case, a fair value gap, also referred to as a liquidity gap, is formed due to a lack of sufficient buying activity throughout that downward price swing. It's important to understand that identifying this gap is based solely on analyzing the impulsive downward or upward candle along with the candles directly before and after it. Any candles beyond this three-candle structure are not relevant when defining the boundaries of the gap. These liquidity voids are critically important because they often act as high-probability entry zones, given the market's tendency to be drawn toward areas with liquidity. When price starts to decline, it frequently targets zones of liquidity that sit above the current level. As a result, these upper zones may temporarily attract price upward before it reverses back down to fill the gap and resume the bearish direction with more intensity. Now that we've grasped the underlying psychology driving fair value gaps, let's explore how we can leverage these zones to anticipate the market's next moves and directional bias. One of the most critical elements we can use to forecast price direction is observing how price behaves upon entering a fair value gap. If the price respects this zone and reacts by rejecting to the upside, it typically signals that price intends to push higher and reach the buy-side liquidity stacked above the most recent high. On the other hand, if price enters the fair value gap and fails to show any significant reaction, this is often a clue that the market is likely to continue dropping, aiming to tap into the sell-side liquidity sitting just below the recent low. To strengthen our grasp on how fair value gaps function, let's take a look at the precise method of identifying them directly on the chart. Now let's explore how fair value gaps can assist in forecasting upcoming market trends and directional bias. A major clue for gauging price direction lies in the behavior of price action once it enters a fair value gap. If the market acknowledges the fair value gap and reacts with a clear rejection to the upside, it's an indication that price is gearing up to move higher, likely aiming for the most recent buy-side liquidity that has built up above the latest swing high. In contrast, if there's little or no reaction when price steps into the fair value gap, this typically signals a higher probability of downward movement, targeting sell-side liquidity resting below the recent low. To reinforce our understanding of how these gaps behave, let's walk through the process of identifying them directly on the chart. Consider a group of bullish candles for this analysis. We'll start at the base of this candle sequence. Here, we spot a three-candle formation made up of green candles. By extending lines from the top wick of the first candle to the bottom wick of the third, we observe an open space between them. That zone represents our first fair value gap. As we move along, another valid fair value gap is visible in the next three-candle set. Eventually, price reverses downward, sweeping through and filling all previously formed gaps. Then, a strong bullish impulse appears. So where's our next fair value gap? If we connect the top wick of this red candle to the bottom wick of the next green candle, we spot yet another fair value gap. A little further up, we find another three-candle cluster. However, when drawing the lines this time, we see no gap between them, meaning no fair value gap is present here. Next, if we examine another three-candle segment and draw from the first wick's top to the final wick's bottom, a gap appears once again. This imbalance was already addressed and rebalanced by the next two candles. At the top of the candle sequence, we have one more three-candle pattern. Drawing the lines reveals another untouched fair value gap. So within this bullish move, we've identified two remaining unfilled fair value gaps, one situated near the top and another at the far bottom extreme. The market has a natural tendency to revisit these zones to rebalance the liquidity voids before continuing its bullish trend. It's possible for the price to reverse from the upper fair value gap, or it could dip deeper to mitigate the one closer to the base. Both paths are plausible depending on broader market context. These exact techniques and principles also apply to bearish structures. Now, let's switch over to a live chart and break down how to use fair value gap logic effectively within market structure mapping. Let's break down the EUR1 United States dollar hour chart that's currently on the screen. As you can clearly observe, the market is showing strong bearish direction. To identify high probability fair value gaps, FVGs, the first step is to wait for a valid break of structure. In this case, the price has driven lower and broken below a significant previous low, closing beneath it, confirming a legitimate break of structure. With that confirmation, we now move on to locating potential FVGs formed during the recent bearish impulse. In a bearish context, your analysis should flow from top to bottom. Conversely, in bullish conditions, the reading should go from bottom to top. We'll begin our examination from this recent swing high. Here, we can see a 3-candle formation right at the market extreme. Drawing a line from the bottom wick of the first candle to the top wick of the third candle reveals a clear, unmitigated fair value gap positioned at this extreme. Upon further review of the internal bearish impulse, we don't identify any other unfilled gaps within the move. Now, take a look at the inside bar pattern that formed just before a strong inefficiency candle appeared. As we discussed earlier, when inside bars are involved, it's often necessary to use a 4-candle sequence to define a more accurate and optimized gap zone. Here, we draw from the lowest point of the mother candle to the upper wick of the 4th candle to isolate the valid FVG. However, it's important to recognize that this particular gap was fully mitigated by price, so it's no longer considered a tradable opportunity. To summarize, within this bearish impulse, we've identified 2 fair value gaps, one that's already been filled, and one unmitigated gap still sitting at the market extreme. As we've covered, the market tends to revisit these imbalances to rebalance liquidity before resuming the trend. What should we do in this case? We wait for price to pull back into the gap, which it left behind, before continuing in the direction of the dominant bearish trend. Watch what happens next. As expected, price retraces to the upside, fills the fair value gap, and then rejects sharply, continuing the bearish momentum. Now, let's move into the key rules and criteria you need to follow when identifying and trading with fair value gaps, so you can leverage them effectively to align with market structure and enhance your trade decisions. Rule number 1. Before considering a fair value gap, FVG, as a valid entry point, there must be a confirmed break of structure, BOS, or a change of character, CHO, in the market. Without a clear structural shift, you should avoid executing trades based solely on FVGs, as these structural breaks are crucial for confirming whether the market intends to continue its current trend or reverse direction. Rule number 2. In a bearish market, only consider fair value gaps, FVGs, that form within the premium zone when planning to enter short positions. On the flip side, in a bullish market, your focus should remain on FVGs located in the discount zone to execute long positions. This ensures that trades are aligned with optimal pricing and directional bias. Rule number 3. Fair value gaps located at market extremes carry greater significance and should be given higher priority for trade execution compared to gaps formed within internal price structures. These extreme-level FVGs often serve as stronger zones for reversals or continuations due to their proximity to key liquidity levels. Rule number 4. Only unmitigated fair value gaps are valid for trade setups. These gaps are considered single-use zones, meaning we focus solely on the first interaction price has with the FVG. Once the gap has been filled or mitigated, it is no longer a valid area of interest for future trades. That's a wrap, traders. We hope this breakdown helped clarify how to effectively identify and trade using fair value gaps. If you found value in this video, be sure to subscribe and turn on notifications so you never miss an update. We'd love to hear your thoughts. Drop your feedback or suggestions in the comments, and let us know what you'd like us to cover next. Thanks for the continued support. Catch you in the next episode.